including bump club 590 on 39. Which table do you use to determine the required minimum distribution? There are three different life expectancy tables. The tables are found in Appendix C of this publication. We use only one of them to determine the required minimum distribution for each traditional IRA. Determine which one to use as follows. Reminder: using the tables for lifetime distributions, none of us is determined as determining one each year. Divorce or death after death and emotion is disregarded until the next year. However, if you divorce or change the beneficiary designation in the same year, your former spouse cannot be considered the sole beneficiary for that year. Table 1. Single life expectancy. Use Table 1 for years after the year of the owner's death if either of the following applies. You are an individual and a designated beneficiary, but not the owner's surviving spouse, and so then designated beneficiary. Or 2. The beneficiary is not an individual and the owner died on or after the required beginning date defined earlier. Surviving spouse. If you are the owner's surviving spouse and sole designated beneficiary, you will also use Table 1 for required minimum distributions. However, if the owner had not reached 70 and a half when he or she died and you do not elect to be treated as the owner of the IRA, you do not have to take distributions until the year in which the owner would have reached age 70 and a half. Table 2. Current life and last survivor expectancy. Use Table 2 if you are the IRA owner and your spouse is both your sole designated beneficiary and more than 10 years younger than you. Note: use this table in the year of the owner's death if the owner died after the required beginning date, and this is the table that would have been used had he or she not died. Table 3. Uniform lifetime. Use Table 3 if you are the IRA owner and your spouse is not both the sole designated beneficiary of the IRA and more than 10 years younger than you. Note: use this table in the year of the owner's death if the owner died after the required beginning date, and this is the table that would have been used had he or she not died. Note: do not use any of the tables in the 5-year rule discussed earlier. What age or ages do you use with the table? The age or ages to use with each table are explained below. Table 1. Single life expectancy. If you are a designated beneficiary figuring your first distribution, use your age of your birthday and the year distributions must begin. This is usually followed immediately following the calendar year of your owner's death. After the first distribution year, reduce your life expectancy by 1 for each subsequent year. If you are the owner's surviving spouse and sole designated beneficiary, this is generally the year in which the owner would have reached 70 and a half. After the first distribution year, use your age as of your birthday in each subsequent year. Owner's life expectancy. In two cases where the owner dies on or after the required beginning date, you need to use the owner's life expectancy. First, you need to use it when the owner dies on or after the required beginning date and there is no designated beneficiary as of September 30th of the year following the year of the owner's death. In this case, you use the owner's life expectancy for his or her age as of the owner's birthday and the year of death, and reduce it by 1 for each subsequent year. Second, use the owner's life expectancy in the year of death reduced by 1 for each subsequent year, if it results in a longer distribution period than using the life expectancy as detailed in Table 1, single life expectancy, above. Table 2, joint life and last survivor expectancy. For your first distribution by the required beginning date, use your age and the age of your designated beneficiary as of your birthdays in the year between 70 and a half. Your combined life expectancy is an intersection of your ages. If you are figuring your required minimum distribution for 2014, use your ages as of your birthdays in 2014. For each subsequent year, use your or your spouse's ages as of your birthdays in subsequent years. Table 3, uniform lifetime. For the first distribution by the required beginning date, use your age as of your birthday in the year you become 70 and a half. If you are figuring your required minimum distribution for 2014, use your age as of your birthday in 2014. For each subsequent year, use your age as of your birthday in the subsequent year. As 10 years worth of required minimum distribution, the following rules may apply to you. Installments allowed. The yearly required minimum distribution can be taken in a series of installments, monthly, quarterly, etc., as long as the total distributions for the year are at least as much as the minimum required mail, more than one IRA. If you have more than one traditional IRA, you must determine a separate requirement and distribution for each IRA. However, you can total these minimum amounts and take total from any one or more of the IRA. More than minimum received. If in any year you receive more than the required minimum amount for that year, you will not receive credit for an additional amount when determining the minimum required amounts for future years. This does not mean that you do not reduce your IRA account balance. It means that if you reduce more than the required minimum distribution in one year, you cannot treat the excess, the amount that was more than the required minimum distribution, as part of your required minimum distribution for any later year. However, any amount distributed in the 7.5 year will be credited towards the amount that must be distributed by April 1 of the following year. Multiple individual beneficiaries. As of September 30 of the year following the year in which the owner dies, there is more than one beneficiary. The beneficiary with the shortest life expectancy will be a designated beneficiary with both the following five. A. All the beneficiaries are individuals, and B. The account or benefit has not been divided into separate accounts or shares for each beneficiary. Separate accounts. A single IRA cannot be split into separate accounts or shares for each beneficiary. These separate accounts or shares can be established at any time, either before or after the owner's required beginning date. Generally, these separate accounts or shares are combined for purposes of determining a minimum required distribution. However, these separate accounts or shares may not be combined for required minimum distribution purposes after the death of the IRA owner if the separate accounts or shares were established by the end of the year following the year of the IRA owner's death. Trust as beneficiary. The trust cannot be designated beneficiary even if it is named beneficiary. However, the beneficiaries of a trust will be treated as having been designated beneficiaries for purposes of determining required minimum distributions after the owner's death, or after the death of the owner's surviving spouse, following the death of the surviving spouse prior to the date distributions begin. Earlier, if all the following are true. 1. The trust is a valid trust under state law. It would be but for the fact that there is no corpus. Or 2. The trust is irrevocable or became by its terms irrevocable upon the owner's death. 3. The beneficiaries of the trust or beneficiaries with respect to the trust interest in the owner's benefit are identifiable from the trust instrument. Or 4. The trustee of the trust provides the IRA custodian or trustee with the documentation required by that custodian or trustee. The trustee of the trust should contact the IRA custodian or trustee for details on the documentation required for a specific claim. The deadline for the trustee to provide the beneficiary documentation to the IRA custodian or trustee is October 31st of the year following the year of the owner's death. Trust beneficiary is another trust. If the beneficiary of the trust, which is the beneficiary of the IRA, is another trust, and both trusts meet the above requirements, the beneficiaries of the other trust will be treated as having been designated as beneficiaries for the purpose of determining the distribution period. Note, the separate account rules discussed earlier cannot be used by beneficiaries of the trust. You may want to contact a tax advisor to comply with this complicated area of the tax law. Annuity distributions from an insurance company, especially related prior if you receive distributions from your traditional IRA as an annuity purchase from an insurance company. See Regulation Sections 1.41A9-6 and 54.3974-2. These regulations can be found in many libraries, IRS offices, and online IRS. Our distribution tax law. In general, distributions from a traditional IRA are taxable in the year you receive them. Failed financial institutions. Distributions from a traditional IRA are taxable in the year you receive them, even if they are made without your consent by a state agency as receiver of an insolvent savings institution. This means you must include such distributions in your gross income unless you roll them over, or an exception to the 1-year waiting period rule for rollover of certain distributions from failed financial institutions. See exception and rollover from one IRA into another earlier. Exceptions to the distributions from traditional IRAs being taxable in the year you receive them are rollovers earlier, qualified charitable distributions discussed below, taxable withdrawals of contributions discussed earlier, and to the top of page 41 for the term non-deductible contributions discussed later, and distributions for taxable. Although conversion of a traditional IRA is considered a rollover for Roth IRA purposes, it is not an exception to the rule that distributions from a traditional IRA are taxable in the year you receive them. Conversion distributions are includable in gross income subject to this rule, and schedule for conversions is found earlier in Chapter 2. Qualified charitable distributions. A qualified charitable distribution is generally a non-taxable distribution made directly by a trustee of the IRA other than a self-simple IRA to an organization eligible to receive tax-deductible contributions, and you must be at least age 70 when the distribution is made. Also, you must have the same type of acknowledgement of your contribution that you would need to claim a deduction for charitable contributions. See reference to Publication 5.8 charitable contributions. The maximum annual exclusion for QCD is $100,000, and QCD in excess of $100,000. Excluding limit is included in any other distribution. Everybody out of the return trust can also have a QCD and exclude up to $200,000. The amount of the QCD is limited to the amount of the distribution that would otherwise be included in the IRA. Includes non-deductible contributions to the distribution first considered to be paid out of otherwise taxable income. The QCD will account for the requirement of distribution discussed earlier. You cannot claim a charitable contribution deduction for any QCD not included in your income. January 2013 QCD is treated as made in 2012. If you made a QCD in January 2013, you could have elected to have it treated as made in 2012. If you made this election, the full amount of QCD counted towards your 2012 required minimum distribution does not count for the 2013 required minimum distribution. Even if you made this election, you must report the QCD on your 2013 tax return as discussed below. 2013 reporting. If you made a QCD in 2013, include the full amount of the QCD in 2013 Form 1040. Any amount over the $100,000 limit must be included in the 2013 return. Be sure to enter QCD next to 2013 Form 1040 line 15B, 1040A line 11B, and Form 1040 line 16B. Additional reporting requirements if you made the election to treat a January 2013 QCD as made in 2012. If you made a QCD in January 2013 and you elect to treat it as made in 2012, this amount will be referred to you on 2013 Form 1099R in 2014. You will need to include this amount with any other 2013 distributions on your 1040 and line 69, even though or your 1040A line 11A or your 1040 line 15A, even though you already reported on the 2012 tax return. Report this amount on the 2013 tax return, even if it is in the IRA distribution that you are reporting. See 2013 reporting above and follow the reporting instructions there in the 2013 tax return. If the total of the QCDs made in 2013, including your January QCD, that you elected to treat as made in 2012 exceeds $100,000, attach a statement to your return listing your QCDs for 2012 and 2013. If you are married filing a joint return, the $100,000 limit applies separately to each of you. If you are required to file a 2013 Form 3329 because you failed to take your total required minimum distribution for 2013, not include the amount in the January QCD that you elected to treat as made in 2012 on Form 5329 59.